What's up, guys? A stock that was near and dear to my heart actually took off approximately 40% today, and so I do want to talk about it. The company's Abercrombie & Fitch, and so let's dive right into it. You're watching More Money. Let's get it. All right, guys, so let's dive right into it. Abercrombie jumped approximately 40% today, but just keep in mind that year to date, this thing is down still approximately 40%. And so, yes, this was a nice jump. It was really good for people that were sort of like picking this thing off. And I'm one of those. I was buying it at around $70 a share. Now, again, I wasn't on YouTube at the time, but I was still having the monthly calls with the investors, and none of these are ever recommendations. Do your own research. But one of the things that I was looking at was how interesting of an opportunity this was. This was almost like that cigar butt type opportunity that Buffett would talk about in his early stages of his career. And this is what I mean by that. So you can see that in the past 6 months, the shares have declined to under $70 a share. And prior to that, actually, they were, I think it did hit a period where it was under $60 a share in the first quarter. But here was kind of the thesis that I was talking about, and you guys let me know how you feel about this, because there is no right or wrong. Just because I make an investment doesn't necessarily, or let me rephrase, just because I make money making a particular investment doesn't mean I'm right or wrong either, right? Like, you guys could completely disagree with me and also be right. But the point I'm making is, in this situation, you buy the company shares at $70 per share, sell a covered call at approximately $25 a share, which is where they were selling at that point in time. And that was actually kind of crazy with like how do I want to say this? Like, how positive or bullish the market was that the company's shares would recover. Now, I wouldn't buy the covered call. I would use this. I generally use options to reduce my risk, not take on excess risk. So I would sell the covered call at $25 per share. And so my net purchase price is $45 a share. Now, look, if this thing flies past $70 a share, do I really care? No, because that 25 over the 70 over the time period was still north of like a 25% annualized return over 2 years. So I don't care. Heads I win, tails I win. So it doesn't matter. Let me show you the tails part. So what ends up happening is your net purchase price is $45 a share. However, if you look at the balance sheet, and I always look at the balance sheet. In fact, I think that the balance sheet is the most important statement for any company that you look at. And so I looked at the balance sheet. They have no debt. They have net cash of approximately $20 per share. I mean, if you want to get technical, I think it's like $17.23 of cash at the end of the fiscal year last year, but call it just $20 per share for argument's sakes. So you're able to buy the business at approximately $25 per share. Well, here's where it matters. That $25 a share, assuming now the company was forecasting that they would earn around $10 per share, but just assume, just over $10 per share, but just assume for argument's sakes, it's $10 per share. A $10 per share EPS reflects an equity yield of approximately 40%, or a 2.5 times PE ratio. If you exclude the excess cash, you're still buying the business at a 4.5 times PE ratio. So in my opinion, that's an absolutely massive margin of safety. And this is why I almost think of this, I wouldn't call it a cigar butt, but I would almost think of it as like a bargain basement type opportunity. Keep in mind, this is retail. Retail can go down massively, but this is a brand that's been around for a long time. I've been actually talking about Abercrombie on my channel for many, many years. And in fact, if you go back to an old video that I was talking about Abercrombie, if you go back and look at some of the comments, people came back to that 2 or 3 years later and they're like, oh, wow, that was an amazing call. Now, I will say that if I bought shares, it wasn't material at the time, so it didn't move my portfolio in any way. But this time around, it was, I wouldn't call it a material, but I'd say it was a larger position than what I would have done in the past. And so the question is, what happened? What caused the shares to go up by approximately 40% today? Well, it's because they just beat Wall Street's guidance on both top and bottom lines. I will say something to pay attention to is that the Abercrombie brand sales are slowing in the single digits, but they are still slowing. Now Hollister's picking up. Hollister's where you do want to see growth and the pickup, so that's really good. I would say that the guidance is, I guess Q4 is what they're talking about. I'd say overall guidance they did take up, and we'll talk about that. So you can see here that Hollister did grow by 16%. The Abercrombie brands are down 2%, so something to pay attention to. But keep in mind, this company is just a cash cow. Remember, they do not have any debt. Retail is just like that, where if you are, retail is just a high risk, high reward type of business. So if you are generating cash, and these guys are, then they're buying back shares or paying dividends. Now these guys, I like the way they do it. They just buy back shares, so they're very strategic about it. They also keep quite a bit of cash on their balance sheet to address situations where the market can turn on them. And I'll show you their balance sheet later on. The balance sheet's sort of always been clean. And so they did narrow their full year outlook, which is, in my opinion, taking up the outlook. And so that's what's happening here. And so, when I was originally buying it, I'm just thinking, long term, this company's about a 10 times earnings business. And so can I sort of like underwrite or model my my purchase anchoring to that? And as I showed you, I absolutely could at $45 a share. If I'm generating $10 per share over the long term, this investment is doing really well. And I guess what I'm trying to say is that it's more likely than not that this stock will make me money over time. And so here's the outlook. Everybody likes to see this. I do have this. I have the previous outlook in the model, and yes, I do have Abercrombie model because, of course, I bought it for myself. So I absolutely have a model on it. But you can see they took up the growth range, so it was 5 to 7. So I forecasted 6 for the year, but of course you can see that they took it up, so it's really 6.5. Net income, they also took that up, right? If you bring up basically what analysts will do is they'll just forecast the median. And so, they took up the median. Share repurchase was very nice. I would like to see them purchase more shares as the shares are depressed. I like that they did do that. I wish that they did more. It'd be so nice to see this doubled. In any event, it's an aggressive share purchase, and I'm very happy about it. So obviously, number of shares have gone down. Overall, good story for a company that's just a free cash flow monster right now. Now here's my model. And I will make a shameless plug. You can get access to all of my models at the lower tier of the Patreon. And so if you're thinking about it, try it out. If you don't like it, let me know. I'll give you a refund in your first month, no problem. But let's just go back to this. So you can see, blah, blah, blah. Why isn't this working? Here we go. So you can see that revenue has been growing post-pandemic at really strong rates. I am not forecasting that out at all. I do not expect revenue to grow at significant rates. And in fact, I even took the 2025 number down. Now, I modeled this early in the year, so I will eventually have to revise this model, but it is what it is. And you can see my EPS is a little bit high, but that's okay. And then in the subsequent years, my EPS comes down. And reason for which is because I'm not a fan of modeling high margins, which I think are unsustainable. I think this staying around the pre-pandemic numbers of around 60% on gross margin is probably right. And this high double-digit operating profit margin is probably not right. I don't know what the right number is. This could be an aggressive model because you can see if you just average this out here, profit margins are way lower than the 8% over the long term that I'm forecasting out. But I think 8% is probably right. At the bottom end, I'm looking at around 6% as a net income margin going forward. Now, again, that could be aggressive. This is the thing with retail. It does go up and down. So this is why I wouldn't make it a significant part of my portfolio, but it is a smaller part of the portfolio. And, it's enough of a return where I can get a good margin of safety. And so that's what I really liked about it. But you guys tell me how you're forecasting this out, if at all. In terms of valuation, I don't give it a strong multiple. I've taken the impact of the excess cash out, so you don't see $17 per share here. And so with that, it's approximately trading at what I would say is its intrinsic value, or it's really definitely gotten up there. I wouldn't be adding to my position here at all. If you add in the excess cash, it brings this to around 70%, maybe 75%, somewhere around there. Still not worth initiating anymore. So I think, you know, the opportunity is gone after $70 per share. It is what it is, but it was very exciting to see. And then, of course, I just wanted to show you guys the cash position. So you can see they don't have short-term debt, they don't have long-term debt, but you can see that the cash, they kind of just keep quite a bit there. I like when retailers keep a good amount of cash on the balance sheet. They also have some short-term investment. Now, this is not what they presently have. They will report a balance sheet with the quarter, but I just tend to update the cash flow in the balance sheet at the end of each year. That's just how I manage my modeling. And so I like that they keep quite a bit of cash here, but it's the reason why I don't model it as excess cash into the valuation, because it's just part of the business. I just consider it a working capital infusion, but worst case scenario, you have that cushion. So that's why when I was thinking about the original purchase, you know, you can look at it as $25 per share, but it's probably better to look at it as $45 per share. It's still giving you a 22% equity yield, or the effective purchase of the company at 4.5 times earnings, which is more than sufficient. I don't need the 2.5, but technically they could use all that excess cash, buy back the shares, and boom, there's significantly fewer shares outstanding. Probably could have made sense to do that at around $70 per share when the shares were trading at that low, but it is what it is. But you know, I think overall it's an exciting result. I'm excited to see it, and it's just one of those names that I will continue to play. So if the market hands it back to me, I'll take it again. This is a name that I do trade in and out of, and I have done over the last I would say 5 years. I think I've purchased it twice now, and so happy to see the results come in, and let me know what you guys think, if you guys even are interested in retail. But it's just an example of how you can make money on names that are forgotten. I don't even know if Abercrombie is in the S&P 500, so it's an easy name to forget. But you know, when the valuation's coming down to a net purchase price of under 5 times earnings, where the covered call yield is giving you an approximate 50% or greater than 20% annualized, not a bad place to be. And so, nice quick win. Take it. Let me know what you guys think.